Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Binns
and Ernest Sweat. You ready? Let's dive in. Welcome to Meghan Reynolds. You have probably read her tweet or her LinkedIn posts on this topic of this podcast. She's the partner at Altimeter in charge of all capital formation and talent strategies, formerly managing partner at TPG and VP at Goldman Sachs. And she's going to talk with us today about some practical tips on capital formation, integrating public and private market insights, as well as navigating the current VC liquidity challenges. Thank you, Meghan.
Thank you for having me. I'm so happy to be here. So happy to be spending this morning with you all and your listeners.
Well, as your team mistook this for an actual allocator swim, hopefully you're not disappointed that all we're doing is asking you to chat.
Very relieved. Very relieved. Yes, my team saw this on my calendar and did think that I was going to swim laps with a lot of LPs this morning in some sort of allocator group swim. So
jumping in, if you don't mind, we love to sort of ask people how they got to where they are today. Mm-hmm. Do you mind giving us a brief background on your Goldman Sachs and TPG time?
Sure. Yeah, absolutely. So I think I'm, somewhat unique in someone of my vintage. I guess that's a kind way of saying that I'm old, that I have spent nearly my entire career in capital formation, fundraising, alternative investment, client service, investor relations, sales in some respect. Mm-hmm. So that's coming up on 25 years. And that was not by design. I studied accounting and finance in undergrad. I had no idea what I wanted to do coming out of school, except I knew I was very intellectually curious and really wanted to have some financial stability in my life, and found my way to Goldman Sachs in a very lucky turn of events. And in an even luckier turn of events, I was placed randomly in a small little boutique group within their asset management division that was just emerging, called the Private Equity Group. And that was a private equity fund of funds and emerging secondaries business that was raising capital from institutions to invest in this new emerging asset class. And I was meant to be an investor. I worked on some operations related to those funds to start, and very quickly was asked to work on a fundraise about 6 months in, and never left that side of the business. I stepped into what turned out to be a great role for me because it was very multifaceted. It was, you had to be very deep inside markets and investing and analysis, but applying that to raising capital. So working with various people, you had to be a good communicator, you had to be a great listener, you had to, be willing to speak, build relationships, all of these different, it was a really well-rounded skill set, let's put it that way, that also let me travel all over the world and meet really interesting people and learn and just learn a ton. Mm-hmm. At a time when that asset class went from an average of probably less than 2% of institutional portfolios to what is it today? I don't know the actual figure, but probably 20, 15 to 20 on average. And so really have been able to ride that wave of growth of, private equity, which is obviously so much more than private equity today, private credit, private real estate, all the sub-strategies within private equity, like venture and buyout and special situations. I've seen it all. I've done a little bit of all of that. And 10 years into Goldman and playing a number of different roles there, I was recruited to join TPG when TPG had grown to be about $40 billion in assets and had raised 6 massive buyout funds that had grown to be quite massive. They just raised a $20 billion fund, and only with about 4 people that had ever done anything related to client work, fundraising, investor relations. And we'll talk about this a little bit, but that works until it doesn't.
Yeah.
Like, it works when you have great performance and people will fund you without great communication or any really refined sales process or coverage. But it doesn't work in perpetuity, and certainly not if performance is challenged. And so I came in and was probably, three of us started on the same day, just rough justice, but was probably higher number 5 or 6 or 7 on that team that today, TPG's public company and 200 plus billion in assets and 50, 60 people on that team. I ended up running that team with a partner of mine, and we tripled the firm's assets in the 10 years that I was there. And it was a really fun ride, and joined Altimeter about 3 years ago. I was ready for a change, was really craving another entrepreneurial ride, and had been lucky to get kind of exposure to everything that was going on in venture markets, and was truly, again, that intellectual curiosity was just so captivated by everything happening in technology, as well as just the evolution of VC classes and tech as its own sub-asset class, if you will. So sub-strategy that was going through its own boom and bust. And I think that attracts me to where my experiences add value. And Altimeter and Brad are just really, really, Brad Gerstner, who runs the firm, it's just a very unique organization. And so applying my skill sets here and having more fun than I've ever had.
That's awesome. And Meghan, before we get into what you're currently working on, I'm curious on, so many people are, have some hesitation about capital formation, fundraising, and intimidated by it. Was there any kind of one or two experiences that kind of made you, maybe not at ease, but feel more comfortable in like taking this on? Or was it kind of just some natural skill sets that you felt like you really aligned with that function?
I was really lucky being at Goldman Sachs when I started the role, because that was, they were already pretty far along in this kind of defining, and nobody called it capital formation then. It didn't really have a name. And I'm so happy that it has a name today. I literally, no one knew what to call me. I was just part of the investment team, but I didn't really do investing. Like that was just how it worked in the beginning. And then it rolled into product management. But I was really lucky that I was within an organization that had a lot of institutional clarity around what needed to be done to service investors well. And they had that not because it existed just in this private equity group, but from a very well-established asset management organization that had a model to follow from other asset classes, like public equity and fixed income and hedge funds. And so there were these clearly defined roles that would be played. Like there was a sales group, and then we knew we needed to service investors through investor relations. We needed to provide the strategy for our funds. We knew we needed to do all the materials. We ran our own annual meeting. We ran campaigns. So I was very lucky today in starting there that I was able to learn in a place that already had a framework for capital formation. Okay. I think a lot of firms and people don't have exposure to that early, and especially deal people that are starting investment organizations. They're deal people. Yeah. And so that the organization around that is intimidating, they don't really know what it means or how to even start to organize around that. And so I was lucky to have that exposure early, that that role definition was very clear to me pretty early on. And TPG didn't really have a definition for it. They called it fundraising. They didn't really have a definition for it either, but they brought in a bunch of people. Actually, my partner and I that ended up running the group both came from Goldman and knew right away, okay, you need sales coverage, you need product, you need investor relations, we came in and there's a reason they hired people out of the banks. Yeah. and placement agents, because there was a very clear we knew what kind of organization you needed to build to service investors.
For those deal people that this isn't a natural skill set, any practical tips or recommendations on, how they can be more like you?
Oh gosh. Well, I'd say first and foremost is do not underestimate the time that you need to spend on the capital formation part of the business. The beautiful thing that the organization that I came from recognized is that this is a critical and valuable piece of the business, because there is no business without the capital.
Yeah.
None at all.
And I still see people underestimate it. I still see people underpay for it. I think, the two organizations that I was able to, where I started my career, that was the front of the firm. And they compensated you accordingly, and they really treated you as, just right alongside the deal people in terms of level of stature, importance, respect, and a lot of focus was given to that piece of the business. And the leaders of the business focused on it. Like, they spent time on it. And so those emerging deal people, study it, study how to build relationships, study how the great asset management leaders like a Steve Schwartzman or David Bonderman, may he rest in peace, the former co-head of TPG who passed away this week, Jim Coulter, David Rubenstein. They were at one time, and they were really refined capital formation executives at the end of the day, alongside a great investment judgment. And so just like you would study great deal makers, I challenge you to study what those great business builders have done in terms of building relationships, in terms of servicing investors. So that's first and foremost my one tip. And then we could go into lots of other tips and just like the different parts of the business and the different parts of the role at any time you want to dive into that a little deeper.
Well, I think to your point, it made me think of, I'm starting to see a trend of even, first-time fund managers, maybe they're spinning out of their established fund, but the first hire they make is somebody who's a COO who has, covered capital formation before at another place. And so you're starting to see people instill that and see how important that is. I was watching a video of you the other day because where you were saying that you have to always be fundraising. And so having that mentality of like always having these long-term relationships, you're even seeing it in venture, which is, historically been a cottage industry, becoming more and more institutionalized. So I think that's aligned with like people realizing if they don't have that skill, the first person they bring on needs to have that skill.
Yes. Or there's great service providers that can help. I mean, there can be this negative connotation around placement agents because, especially in venture, because there's this feeling that if you need a placement agent, then you're perhaps that's saying that, you need help when you have relationships or you have capital that's already starting. But sometimes what those service providers can do is really teach you what great looks like if you can't afford it yourself. Like, they have relationship coverage, and they have people that just help you with your marketing strategy. And now sitting in an organization where we have access to, because Altimeter has a public business and a private business, we have access to cap intro for the public business at the banks. And I had TPG had a hedge fund, but I wasn't focused on the business building of that piece of the business as much. So coming here and realizing what cap intro provides to emerging hedge funds and established hedge funds was a complete eye opener. What a lucky industry that they have a service that will be provided to you. Well, they will tell you how to build your pitch book. They will teach you, they will point you to the investors that are actively allocating. They will help you refine your pitch. They'll give you advice on how to communicate on an ongoing way. They'll teach you what great looks like. Private markets does not have that. And it's very, very difficult in what is probably a more competitive business today, just in terms of number of emerging managers. And so it's really a struggle, particularly just given the number of funds out there. You really have to navigate it on your own. And I'm glad that some of my work has contributed to that kind of next generation of amazing managers, hopefully in helping teach what good really looks like. And then maybe the last thing I'd say on that is just, and this is to the emerging manager, like, don't underestimate how important it is. I think that people believe that if you deliver great returns, it'll all just follow. And that did work at one point when people were growing the asset class. And this is when I say I was lucky. There were 5 firms doing what we're doing. There were 10 firms doing what we're doing. Like, there are 5,000 firms doing what you're doing today. And competing for attention. That is an impossible place to be. I mean, you're like, I was saying to someone the other day, like, trying to think of markets that have as much competition, like just a product where you have 5,000 choices and umpteen choices if you think about how you might allocate between different strategies within alts. And your experience needs to be more than returns if you're an investor. Like, the investor experience matters a lot. The client experience of what it is like to interact with you, what it is like to receive information from you, like, that is part of your differentiation. And just like if you were, any business, like, client service is so critical, the client experience. Like, and I just see it underestimated, but the great ones know that it matters. And the great ones, really understand that defines your business in just as much as your returns can define it.
It's a very helpful reminder that you aren't. There's only a select few who can truly just deliver returns and not expect people to have any information along the way. This is you got to bring your investors along on the road. And another thing I've been hearing from placement agents is they have their pick too right now, and so it's an interesting flip flop where in the past, if you were a VC, maybe you thought, oh, would I want to use these guys? Would I not? And the placement agents at this point, they actually only want to represent the folks they believe they can really help raise. And so it's I think a helpful conversation to just go have a conversation with a placement agent or two to get a little bit of a reality check on where you fit compared to the other things they're out there pitching.
Yes. Great advice. I think it is. I mean, sadly, I think about the emerging manager landscape. And my advice is think twice. What are you really going to bring that's different and special? That will, if scale is what you're trying to achieve, it all depends on your goals, but if scale of some sort is what you're trying to achieve, you really need to think hard about achieving that. And people will do it anyway, obviously. But I compared it the other day to a friend. I was talking to my friend Rudy, and we were talking about, that it's basically at this point, it's like going to Hollywood.
Yes.
It's like you're competing against unbelievable talent and people who have all done amazing things. And like, there's established talent that has already made it, that they're just going to get the repeat roles, and they're going to get the big contracts, and they've got an agent that's doing it for them. And you're coming in and you're amazing, triple threat, but you're trying to break in. Like, it is that. Or
Right.
restaurant in New York. I mean, this is that level.
Yeah.
And there's people that are just bold and convicted and that talented that they will break in and they will be successful. But during 2020, 2021, it got really easy to start a fund.
Yeah. Yeah.
And now that's just my advice to people. Like, just really think about the market that you're entering.
Living in LA, I came up with a reality show concept called Go Home.
Yeah.
And
Yes.
you get the chance to appear before a slate of judges. One will give you an agent contract for modeling or singing or acting, whatever.
Yes.
And you've got a live audience. And if nobody buzzes that they want to give you a contract, they get to shout, "Go home."
That's
Perfect.
And you have to take your suitcase and get in the limo and cry. And your family welcomes you back. Your family welcomes you back and says, "Now you can start your life."
Right. Right.
and
And then there's the people that are like, you know what? I'm not going home.
Exactly.
I'm going to prove it to you, and bless them all. Bless them all. Well, you heard it here first. I would watch that show.
Go
Yeah,
home.
there's a venture capital version of that. Just go home. Go join someone else that's doing it already. Go join a big platform that will help you build your track record. Go, and also just like think about this. This is not a get rich quick
no.
scheme. This is a 20-year.
Very slow.
In the words of, what's that time? Jerry Maguire. It's a 20-year, pride swallowing siege. It's that hard. And it still is, by the way, for me today. Like, Altimeter has an incredible track record. Brad is a legendary investor. And it's hard to build new relationships.
Yeah.
And raise scale capital.
That's so good to hear for folks listening. This is not personal, actually. This is just statistical. Yeah.
And it's just the
statistical.
market. It's the market right now. Although, Meghan, now you're going to make me think like, all right, am I John Hamm? Like I'm just waiting on my Mad Men. You're going to have those people, but I see your point. Like, you actually need to know why you should exist. We hear that all the time in all our interviews of like, do you know why you should have the right to exist? And how to sustain? Because even the best and the most storied firms are, it's difficult and it's more competitive. And to that competitive perspective, how do you think GP and LP relationships are going to change over the next decade?
I think it will we're entering a new regime, and I think that this has happened in decades, or maybe kind of you've gone through these kind of 5 to 10 year phases of the industry, and I think that buyout went through it already earlier, and venture's going through it now. Buyout went through it a lot. Happened around the financial crisis. Like, buyout had the big boom early 2000s, went through the financial crisis. That's when all the buyout firms hired capital formation teams. That's when you saw firms go away. You saw, there was tons of middle market firms emerging. They refined their process. Like, I think ventures, the big got bigger, and more specialized firms emerged. I think that venture's going through that right now, and it's in its next phase. It's in that phase. And I think the challenge is that people have most institutional allocators have large venture growth technology exposure already.
Yes.
Yeah.
And there's no wave to ride in terms of fresh new capital emerging that people of the last 10 years got to ride.
Yeah.
Lucky time. They had lucky timing. because they had time to build a track record. Like, there is no huge fresh wave coming for most institutional allocators. Again, and everything I say is a sweeping generalization. There are always exceptions. Yeah. Everything from breaking in and all of that stuff. Even what I put on Twitter, that's just one perspective. But there are always, I just met somebody this week that's building a new venture program, and it's a large institutional pension, but it is few and far between. Mm-hmm. And so what does that mean? I would say there's something that happens in this phase, and a couple of things. One, there's consistency that emerges between how firms communicate with their investors, because the standards start to emerge. Mm-hmm. And same thing happened in buyout. So there was no standard reporting. There was very little information. That is now, again, you've got to compete for capital. So the LPs have all the leverage, and so they're going to demand like a certain level of transparency, certain level of communication, a certain amount of institutionalization around your process, very clear about timelines. You can't stuff people by saying you're coming back after a year with a capital raise, or, do things that are really off-piste, because it's just, you're now working within a framework. And again, there could be exceptions, and there always are exceptions for phenomenal cases and firms and things like that. But this is what happens in this phase. And so I think there's more consistency around the levels of communication, transparency. I think there's more institutionalization of process. I think there's more team building. And I think there's more creativity that happens. And this is something that I learned at TPG. Like, if Goldman taught me really how to, like, what it really looked like to service a client well. Like Goldman, it was like the client is like the number one piece. It wasn't the deal, it was the client. And that I learned that at Goldman. And at TPG, I learned solutions and creativity and being strategic to someone. And so what does that mean? Yeah. That means in this phase, because it's so competitive, you really have to be more creative in how you build solutions for people and really understanding what each individual investor needs. We met with an investor last week that we were, talking about expanding our relationship, and we're listening. We're saying, you know what? What's really important to them is training their team. And what if we could help them understand venture as an asset class? Like, maybe that helps them build a relationship. So, and I'm talking mainly now about the big institutional side of the business. Maybe it's I think separate accounts will emerge. I think that unique co-investment structures, again, this is where it gets creative. It's not just I'm raising a fund and that's it, and it's 2 and 20 and with a step up, and that's the end of the go. Like, there are unique funds, structures, solutions, relationships that emerge that help people find a way to capital. And then I think there's this whole other piece that's really interesting part of market that's happening in the next 10 years, the LP-GP relationship with the emergence of the retail LP. Yeah. And that is actually a wave of fresh capital coming into the asset class. And I'm very fascinated by how it's going to unfold. And that's private markets generally. That's not just venture. That is private markets generally. And that is something that's unfolding real time. Secondaries, liquid solutions, bank platforms have been around for a while, but they've really been limited to certain wirehouses and certain structures and super ultra high net worth. And I think that with the returns that have happened in private markets, with the lack of institutional capital at the ready, and with the returns that are with just the returns that are happening now in private markets and companies staying private longer. I think that there's this effort underway to realize that unless you're an ultra high net worth individual or an institution, you've completely missed out on this entire category of investing for the last 20 plus years, where all the best, where some of the best returns have happened, like alternatives have outperformed traditional markets. And so how can we translate that to a more retail-oriented investor? And we're seeing bits and pieces of that emerge. There's some really interesting products out there. And that's my prediction of the next 10 years. 10 years from now I think it will be a more pervasive asset class. And we will need to adapt our organizations to account for that.
Now we're going to take a quick break to speak with our sponsor.
Now we have the pleasure of having our guest today, Luiz Rabelo. Luiz serves as the director in the technology banking practice at Silicon Valley Bank, focusing on venture capital-backed technology startups in Florida. He provides strategic advice, banking services, including debt financing to these companies. With that, I want to just welcome you, Luiz, to Swim with Allocators. Thanks for being here.
Thank you. Thanks for having us. Thanks for coming to Miami.
Love Miami, especially during the winter. You spoke about it a little bit, but just like the importance of having the local knowledge and understanding of this ecosystem to actually succeed in being a great service provider. Could you talk a little bit about like what other people might get wrong if they're just like, throwing a team together here?
Yeah, I think Florida, like any large state, right? I'll make a comparison to California or Texas.
Yeah.
The large territory, Florida in particular geographically is challenging places to cover from a service provider perspective. But even as an investor, I think Florida has the subcultures, right? Both culturally, but also just regions that are vastly different from each other. And so I think being on the ground allows you to really get into the fabric of the community, understand the local challenges, but also kind of the regional preferences, and the language that dominates, or the second language that comes into play. And I think particularly in Southeast Florida, where you have this element like a gateway city, right? You have 3 international airports, tons of private airports, and then you have people coming and going from all over the world, but particularly I'd say the Northeastern US, South America, Central America, Caribbean, and then Europe.
Yes.
Western Europe especially. So I think Miami brings many people together in ways that are very interesting, right? And so this is like the fourth corner of the country that venture hadn't yet quite, or tech, SC hadn't yet quite dug its heels into.
Yeah.
So it was always there though, right?
Yeah.
And so I think the dynamic here, it presents a few challenges that if you're not on the ground and if you don't get to know the people, if you don't embed yourself in the community, you're never really part of it, and it never really becomes a part of you.
Yeah.
And so there's an exchange that has to happen. And I think it takes a few years for you to really, decide that you're going to call home, or that this is where you want to be long term.
Yeah.
So I made that decision years ago, and I think over the years I've gotten to know many people that also have, right? Before it is a state of migrants, it's domestic migration, but especially foreign migrants. And I think that's a unique feature to Miami. It's a major city where I heard a stat, and don't quote me on this, but probably about 60% of the residents are foreign born. And I think a lot of those people choose to pursue their happiness by way of entrepreneurship. We specifically in SVB focus on the category of venture.
Absolutely.
Right? And so I think Miami, South Florida, and Florida in general presents a unique set of features and also opportunities that we're excited about. So.
Yeah, just hearing about, like you speak about the entire community, it is like a melting pot that is going to have a lot of innovation, different perspectives, and uniquely in a way, I've respected it with Miami and South Florida overall, not trying to be Silicon Valley, right? Like I think that's the problem a lot of ecosystems have is we want to be the Silicon Valley of the East or whatever. That place is unique. you're unique too. Be whatever you are. What challenges and opportunities do you see for investors who are looking at Florida startups now?
Yeah. I tend to focus a lot on the opportunities.
Yeah.
But being aware of the challenges and how to navigate them is extremely important. So I think, first of all, you touched on it. I think it's understanding the conflicting narratives.
Yeah.
Like getting into the community, understanding the facts, and realizing that there's a different side of that. I think there's a tremendous opportunity to realize that the profile here is unique to any other major city in the US because of the demographics. And if you want to draw parallels to like a New York or San Francisco, do so, but to the New York of 100 years ago, 150 years ago, when a lot of immigrants were landing in New York.
Absolutely.
Right? And they were starting new businesses and they were first generation Americans. I think if you make those parallels and you extrapolate that forward, you can think, wow, there's so much potential, because every major American city that we've seen that has had such a huge influx of migrants move there within a 10, 20 year period, 30, 40 year period, maybe if you go back to the 60s, I think there's also a century later like this wave of development, expansion, opportunity, and I think Miami, South Florida is experiencing that today. And so I think while it presents a challenge of understanding a different shade or flavor of culture, diversity, right, I think it also presents an opportunity of being able to expand your horizons, work with founders that think very much globally in a native way, right? They're not just thinking, well, let me just do the US and that's enough. It's like, no, it's not enough, because, I was born, or my parents were born in a foreign country, I speak that language. Why not, scale to Brazil? Why not scale to Europe at the same time that I'm scaling in the US?
I love that.
Why not hire someone from a foreign background that has a second, third language, right? And I think, why not have a remote team that's developing software in Colombia, or we have many people in Ukraine, Eastern Europe. And so I think that the founders here bring that dynamic to the world of venture. I think other challenges include that the concept of access to workers, particularly software engineers.
Yes.
Our ecosystem was not built on the backbone of I'm going to say, world-renowned universities like Stanford in the Bay Area, or MIT in Boston, or other universities you have in New York. We've had some of our homegrown universities, which we think are great. But they may lack specific skill sets, or they may lack specializations that venture in the world of tech wants to see. I think there's an opportunity to invest in that. We've seen many universities open remote campuses here. And I could probably list 5 or 6 that are offering courses locally. So that's a I think, foundation point, right, of supply meeting demand, sort of say. But I think there is a challenge where if you want to hire local, you have to be more flexible. You have to be willing to convince someone why this is a good place to live, right? But I don't see it as an impediment, not at all. As a matter of fact, I've seen many founders successfully navigate that challenge and still raise capital, scale their businesses. Especially in this remote world. You don't have forwarders, domestic forwarders like we used to have. Right?
Exactly.
So I think that's another dynamic. So talent. Access to capital is an interesting topic that you could probably spend some time on, because I think historically Florida has always had capital. Blocked, right? You see it in the jets, the yachts,
real estate,
the family offices. A lot of them are here. But they may not have looked in their own backyards as a place to invest in the past. But I think recently, I'm going to say 10 years, because we have to think very long term for this business, right? But I'd say probably the last 5 to 10 years, more and more investors are looking in this region as a source of opportunity. So I've seen a lot more of that happening. I think that's where SVB has been a strong advocate and player, where not only do we provide business services like banking and lending, but we also serve as a connector in the ecosystem we provide events like this one that we
Yeah.
had this week, right? That allows people to come together, network, and form natural relationships. So that's something I think that helps navigate those challenges that help create opportunities for us today.
And now back to our LP interview. Since you've seen this idea of sort of institutionalizing your reporting and streamlining your reporting, since you've seen that across these other asset classes, I'm curious, do you think venture actually has access to this information? Or is part of the reporting problem built into the style of betting? I'm curious, when you think about what information we have available to report, can we meet institutional investors' expectations if they have sort of a, I don't know, or is that maybe me just making excuses on behalf of venture?
This is a great question. And this is something that I debate with people a lot who push back on me on the transparency point. Because it comes down to the founder relationship and the companies and what is confidential and what's not and what's proprietary and what's not. And I think that it's going to have to start at the top and trickle down. And so it really starts with founders and how they treat their client, like their investors.
Yeah.
And I think that there's a whole class to be given to founders on like what good investor relations looks like. Because it's shockingly bad. I've sat on boards. I've been been lucky enough to have enough exposure to that it's hard. And I get it. You're starting like an early stage business. You've got so many things, like it's impossible and you're just trying to survive. And the last thing you're going to do is like make pretty information for your investors and get back to them on a quarterly basis when you've got like you're working 20 hours a day just grinding. Like I get it. There are so many challenges. You can't solve it all. But I think it's just like what people value and it's what investors demand at the outset of when they're raising capital from founders. I don't think if you're at the seed and super early stage level that there's going to be this huge need for like operating metrics that are disclosed to all of your underlying investors.
Yeah.
I think it's much more straightforward than that. It is what is going on at the company. You know, investors get it. They know there's limitations. They're not totally immune to what you're going through as a fund manager, but it's really taking the time to give enough of like anecdotes to give them a sense of really, is it going well or is it not going well? Is it and look, there's a lot of trust in that. That is a leap of faith for your investors. I've seen it. People have trouble internally. Like people won't even communicate what's going on in their companies to other people on their own teams because they're so afraid of upsetting the founder because it leaks and there's competition. And that's a problem. Like if you don't trust your own team to keep it confidential, and then you have to trust your investors to keep it confidential. And I think we just really need to think about like what is actually confidential
Yes.
and what is just basic standard information. And so there wasn't a good answer in that. That was a winding road, but I think like it doesn't all have to look like a spreadsheet of operating metrics. Let's put it that way.
No, I think you're getting to the point of the trust and transparency. And I was talking a couple months ago with a friend who's in capital formation and has worked in venture firms as well as hedge funds. And her point of view after leaving a venture fund was things have to change where they're more like hedge funds with transparency, and just it's not the metrics, but like, what's going on? What have you learned? How are you going to change your strategy based on it? And being in this business for a decade, I've seen that like there's a level of humility and being vulnerable that I would say on average our industry hasn't taken. And maybe that's going to be a differentiated factor for those who are comfortable enough to do that, to have trust of like, hey, we know, the risk of our asset class, but I'm actively learning and showing conviction. Yeah.
And that is so important as they think about committing, your LPs think about committing to your next fund. They have to have a true sense of how things are going, even though not a lot's happened.
Yeah.
They have to know how you're learning, how you're evolving. And all of this can be, there are different ways. I do think there will be some consistency that emerges. In the buyout end of the spectrum, there's something called the Institutional Limited Partners Association, who basically set standards, hard standards around 08, 09, 2010 that just got laid out. They don't really apply to venture, because if you're a great venture manager, you can say, I'm good, I'm just not going to take your capital. No, I know firms that say, sorry, you asked too many questions, you're out. We kicked you out. We kicked our LP out because they asked a lot of questions. Horrifying to me. Horrifying.
That might explain.
Would you treat your, like, is that how you treat your partners? They just need to know.
You're
what?
lucky to be included, Megan.
You're lucky.
Yeah.
You're like, and like, hey,
Taylor Swift getting rid of a crew member.
I get it.
You seem like a little high drama, so no thanks.
Yeah, no thanks, you're out. We have a waiting list, and if you can be on it like that okay. That's one. Is that really how you want to be? Imagine being on the other side of that. Like, they think that this goes to the reporting and transparency. Every one of the 95+% of the people that are invested in your funds will have someone else that they need to report to.
Yes.
About what's going on in your business. And they are your advocate. They are your champion. They are the one that's going to, like, and you need to feel what they feel and be so grateful for their support and help them do their job.
Yeah.
It's not just pitching a principle of a business and you're going to get capital and that's the end. Like, that's why I say the person that's asking those questions, that storied venture firm, that's an endowment employee that has a board that they're hired and fired on this job, and to say like, no, we can't answer those questions, you're kicked out, that's I don't know. It's just a little, to me, it's just a little harsh.
Yeah.
But look, I also get that institutional fundraising can be very frustrating. Like there is the institutional allocator process can be very exhausting sometimes, and doesn't always feel like it feels process for the sake of process, which can be frustrating sometimes.
Megan, do you have advice for somebody going through that institutional LP process for the first time? Do you have any tactics on how to even kind of characterize the market and certain types of going to a pension fund versus a endowment versus a sovereign wealth fund, and things that they should know and consider?
Every investor, not all investors are not created equal.
Yes.
But there are definitely consistencies by channel, and understand meaning like exactly how you said, pensions, endowments, sovereigns, individuals. There are patterns that emerge. And I think one way to go about it is kind of solve for the most complex first, if you're really going out and going to all. probably the most complex from a process standpoint, from a informational data room materials standpoint, is probably the consultant community. That I would say probably the consultant community or the pension community, just in terms of information that is required. So look, I would maybe start there and ask friends or LPs that call a consultant that you've had conversations with and say, hey, I know I'm not in your process, but I would really appreciate understanding what your process looks like so I can know what great institutional capital raising looks like as I build my own business. Can you share your DDQ or your data room asks? Because I don't even know what people expect to be in a data room. Yeah. I have a hard time. Like, they're going to take initial meetings, and asking that question at the meeting, I think, is helpful. And a lot of those groups do have emerging manager businesses where they are supporting emerging managers. So they will be inclined, I think they would be inclined to be helpful in that regard. And maybe a shout out to ILPA to put that out there for VC managers, like what the expectation for what institutional diligence looks like.
We also would recommend people be following you on social, et cetera. You shared recently some of the insights that you put together for your AGM on VC power law. And I think we'd be very lucky to get to hear from you on what some of these things are that you're pulling together for your own LPs.
Oh, yeah. Absolutely. Well, we can talk about some of that. I am really frustrated at the moment, I think, broadly, the LP, generally what I hear from LPs in the questions that they ask and the way that they analyze portfolios and track records in venture relative to how the asset class actually works in practice. And by the way, there's plenty of very sophisticated LPs that I work with that do understand how it works in practice. And again, but let's just say I've encountered a lot in my journey that seem to be putting a lot of emphasis on success, which are things that aren't necessarily what drives success in venture. So what do I mean by that? So power law. I think mostly people now are very familiar with the power law concept, which is just kind of in a venture fund applied. It means that a very small number of deals will drive the return, will drive returns of the fund. A very small number of deals drive returns for the entire asset class, and in a small number of funds drive the outsized returns, and those funds get the outsized returns from a very small number of deals. And so if you're thinking about a VC as a power law business, I would imagine in the seat, you're looking at that and saying, have you had access to power law deals? Have you been able to do that? Or what is and because most VC managers or most VC LPs are looking for outsized returns, 3x plus. And if you look at the underlying data, the only way you receive 3x plus funds is power law. If you have access to power law deals, that's it. Top quartile is not 3x. It's not 25% of funds are getting 3x plus. It's like top decile is getting 3x plus. So the whole question is do you have a shot at getting access to power law deals? And that's the emerging GP of saying do I have a shot at that? And if not, then what is my mission and what am I delivering? Because it's not going to be the 3x plus, because if you look at the whole asset class, it's very clear what's required for the 3x plus. And so, and I don't necessarily hear that being the question or the analysis that's being done by most people. I think, and by the way, what that means for all the funds. And we did this whole analysis with Stepstone, who's our amazing partner on data. Follow them, get access. Their data is incredible. They have their Greenspring business that they acquired has been investing in venture and is one of the great fund of funds for 25 years plus. And so they just have access to tons of deal information, but their secondary business feeds all of that. If you look underneath the hood, the loss ratios within venture funds. So it's not only just you had access to that, but you lost lots of capital along the way. And other great voices in the industry, Fred Wilson, Mark Andreessen, like everybody's reinforcing this.
Yes.
That to get a 3X plus fund, you're going to underperform on 75% of what you do.
Yes.
And you just got to hit it right and weight your capital right on the really big stuff. That's what's going to drive success. And so if I'm an LP, I'm sitting there thinking, like, do you have access to the potential big outcomes? Can you get access to those power law deals? And I'm not focused on the fact that you lost capital and underperformed in 75% of what you do, but like, are you weighting capital appropriately to your winners?
Yeah.
And I can't tell you the number of conversations that I have about consistency of returns, on loss ratio, on, and again, I understand this is what boards look at. This is what their investment committees look at. They don't want to see a one hit. But now that I've been sitting in the asset class for 3 years,
what
I'm
you
like,
do
want
to see.
That's the whole, yeah. It's like why you're in venture.
Point. And there's our investor day 2 years ago, we talked about, there's a paper out of Harvard a few years ago that showed that if you have access, if you've had access to and had a big power law winner, that the likelihood of you having another power law winner goes up, I don't know, I forget the data, 10x or something like that. And so if you've hit it, you're probably going to hit it. Chances are you're going to hit it again. And the more that you've hit it, like it keeps going up and up and up in your early years of success. And there's obviously so many reasons for that. So like you've now got logos, founders know you backed a great one, but it also your judgment around portfolio management and did you weight capital appropriately and what did you do with your reserves? Did you put it to your winners and not the losers? Like, so I would just really, and I do think it's happening, but I would love to see more consistency around the evaluation of venture different than I think what you have is a lot of allocators that maybe have managed private assets, and it's a big leap to think about buyouts and growth, mid-growth, which is really like small market buyout, totally differently than venture. And they haven't spent the time to understand the nuances of that asset class. And as we move into retail and family out, like no one's done the work on that. And so I think it would be, and it's so different than every other piece of investing. So, I'm trying to carry the flag on that one, and not from this is not for my own benefit. Although look, there is some benefit to this because Altimeter's been a top decile fund in our early years. So let's just say, without disclosing anything, that like perhaps our behaviors have represented that, but there's a lot of nuances in that. But it's really just for the industry as a whole. I think it would make everybody's life easier. I think it would help GPs understand whether they have a shot at success. I think it would create more consistency, transparency, all of it. So that's the flag that I'm carrying on the data side. The other one, and not to ramble, is around fund sizes.
Yes.
And fund math. And there's a data analysis that I would like to do, and I need to talk to the Stepstone folks about it, is just, how many 3X plus $2 billion plus funds are out there?
Yeah.
Yeah.
Can anybody name one?
Yeah.
Realized? Or 2 or 5? Like, there's just a rationalization around the size of capital for venture. Venture, because of power law, and these other asset class behaviors doesn't scale. Growth scales.
Yeah.
Growth scales. But venture doesn't scale. And so, and I'm sure I can get into a heated debate about this with lots of people, but that are intimidating. But I do think that that's also, this challenge. And it is a challenge because large institutional allocators want to get lots of capital to work. So people are incentivized to raise a bigger fund so you can actually appeal to larger institutional allocators. But, if you're investing in Series Seed or A or B rounds that are only 20 million in size, even if you 15x it, which is nearly impossible to achieve, if you size your fund too big, it's not going to move the needle, and power law doesn't happen that often. So, are you really going to 3x it? So that's the other data analysis take up that maybe you'll see from me in the new year.
I love that. That's you're preaching to the choir here. I'd love to hear any kind of parting thoughts to our two communities of GPs and LPs. Anything you want to share?
Maybe, an ask to the LP community. I think communicating to GPs as they meet them, one, what good process looks like, what they expect from a partnership, whether or not you're going to invest. I think it's a service to the industry that will keep getting better if they hear the feedback from you directly. And I think embracing the radical candor will help people immensely. I think there was a talk I gave on Jason Calacanis's liquidity podcast that talked about encouraging people to ask the questions at the end of the meeting, is this something that you're likely to allocate to? So that it saves the time of, should I be doing the follow-up, or maybe I can postpone that to next year, or what are my chances of actually getting stuff done, because people are having meetings with lots of LPs, and I maybe put that to the LPs to say, more candid feedback of, this is great, but there's no chance I'm going to be doing going to be investing in this next year, but I'm actually interested, or I think you need to build out your organization and listen, your track record's just not there. That will be so helpful to everyone to just kind of get that real feedback. And then to the GPs, that it's a call for empathy to the LP community. I think I talked about it earlier, really putting yourself in the seat of your investors, and that's to the founder community. Think about that, the founder community, think about that your investors have investors.
Yeah.
And they are your champion. They are on the hook. And your investors knowing that company and their successes will actually help the flywheel of capital come your way. And so there actually is incentive to the extent that you have success. So there is incentive to share information and take the time to try to share information with investors. And so those are some thoughts.
Well, Meghan, thanks so much. I've been a follower of your content for a while, always appreciating your candidness and intention. And so thanks so much for being on the show, and can't wait when we have live swim meets, you being the first guest on the live show.
Get ready, allocators.
As we have allocators swimming behind us, that would be great.
The swim meets. It's so good. I cannot wait. You heard it here first. Get ready. Get your goggles. Start training. And as Alexa said earlier, true San Francisco fashion, it's going to be a competition.
Absolutely.
So
Meghan,
good.
Thanks so much for being on the pod.
Thank you so much for having me, for your support. I'm humbled, and I love the conversation. So thank you.
See you later, allocator.
After Portfolio Tile, investing with a smile.